Okay, good morning, everyone, and welcome to what is now the 45th edition of the Coffee Microcaps morning meeting. You're all very welcome to this morning's event. For anybody who's joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and I'm just going to quickly run through a few introductory slides, and then we're going to get straight into it with our first presenter this morning. Quick compliance and disclaimer. For anybody who is joining us for the first time, generally the companies we have presenting at these events are under 300 million in market cap, in revenue and approaching cash flow break even, or indeed are already profitable. We generally focus on companies outside the resources and the biotech sectors. It's what I call industrial microcaps. So that could be microcap technology names, microcap industrial products or services businesses, microcap retailers, niche retailers. It's basically all the other sectors except for resources and biotech, which we just call industrial microcaps. Structure of this morning's webinar, as always, we're going to have two companies presenting plus minus over the next hour. Each company presents for 30 minutes, which we roughly break down into a 20-minute preso and 10 minutes of Q&A. Please, if you do have any questions, to type them in the Q&A box in the nav bar rather than the chat function. It just makes it easier for me to moderate the questions to our presenters at the end. Please note that this webinar is being recorded and it will be posted to the Coffee Microcaps YouTube channel tomorrow morning. So if you can't stay for the full event, you can catch the rest tomorrow morning back on YouTube. You can follow us at C Microcaps on Twitter is probably the best place. As I said, the recording of this webinar and indeed the recording of all the previous webinars is up on our YouTube channel, LinkedIn, where I also post some more long form stuff from time to time. I also write a weekly subscription newsletter where I profile one interesting ASX microcap stock every week, and you can get that via the Substack newsletter platform. Up first, we're going to have Martin Filz, CEO of Pureprofile, and then after that, I'm delighted to be welcoming back Shaun, Ankers, CEO of Energy One Limited. So without further ado, I'm going to stop sharing my screen and I'm going to hand over to Martin.
Hopefully you can see that, Mark.
I can. Yeah, now you're in full screen mode now, Martin. You're ready to go.
Cool. Well, thank you very much for the introduction, Mark, and welcome to everybody. And thank you for your interest in Pureprofile. So for those of you that don't know, a quick bit of potted history. We're a 21-year-old company. We went public in 2015. 2016, we made a couple of acquisitions that didn't quite work out for us. That resulted in 2019, bit of a restructure. 2020, I came on board. We did a recapitalization and we focused the business on what we're famous for, what clients really wanted from us around the world. We invested in our team in those areas of focus. We brought in some world-class talent, and along with that restructured 2019, 2020, we have not looked back, and I'll tell you how we did last year. So our aspiration, firstly, it's the Pureprofile Insights. We're a data and insights company with a media arm, but Pureprofile Insights is used in every company in their decision making. Today, over 18% of the ASX 200 use our data, and that's a lower percentage when we look at FTSE and Dow Jones. So we have global aspirations to improve that. Our vision that Pureprofile's data, we add more value from the world's information. This is really important. 90% of the world's data was actually created in the last 2 years. We're all spending more time online, etc., etc. Brands and companies need people like Pureprofile to help them make sense of their data, understand their consumers more, and therefore sell more. And our mission actually is also to reward people for sharing their thoughts, opinions, and behaviors, and also then to provide valuable, actionable insights for businesses. What does that mean? That all of our members, all of our data that we use, we reward the people for sharing that. So we overcome any privacy issues, PPI data, etc., because we reward people. So aspiration, vision, mission. Our values, discovery. People should always be asking why and how. Ownership, take ownership for what you do. Trust in our clients, in ourselves, in what we do, and work as one team. And I'll talk about our amazing people that we have in a couple of slides. At the heart of what we do is we help organizations understand their consumers, as I just said. So take this person at the outset. We might see, or brands might know, she's 34 years of age, single, lives in Byron Bay, earns a certain salary. What we do is help them understand much more this consumer. Perhaps that she drives a Lexus hybrid. Therefore, Volvo, when they talk to this individual, will talk about high-end hybrid cars to maybe move her from Lexus to hybrid. Which she works at Wildlife Conservation Centre. Medibank will actually contact and deliver advertising to this individual about ethical health insurance products to move her perhaps to Medibank. New South Wales will send messages around climate change and what they're doing around there to influence her vote. And Bernardo's Australia can see that she's an ideal target for Christmas donation. So as I've outlined, 90% of all insights that we generate about individuals is actually so brands are able to connect better and then either cross-sell, upsell, or bring them into their company. On the first slide, I also talked about having a clear focus and a clear strategy today as a company. And this was a strategy that we put in together at the beginning of financial year 21. And it's a three-pronged strategy. Number one, to ensure that we grow globally. We already have global data sources, global offices. I'll talk about those in a second. 60% of our revenue today comes from Australia. And a key point that investors are asking for is that we grow into our global footprint and we grow into the scale around the world. So growing our global panel, global data sources, and global client base. The second area is within our SaaS, within our self-service solutions. We have 3 products within our self-service solutions. The more our clients use those, that gives us scalability, it gives us efficiency. It enables clients to access data or campaigns, media campaigns, whenever they need to. And then thirdly, when we have that self-service rolling out as we do, we have the global footprint. Then our 2 core divisions of data and insights division and media advertising division can equally sell more to clients. We can engage with more clients. We can upsell clients from self-service to using our premium services, and we can grow those 2 divisions. So it's a very, very clear strategy that both clients are asking and also investors are asking us to do. Our business. So why do clients work with us? As I said, we're a data and insights company and a media company at heart. So firstly, we offer access to clients to millions of deeply profiled consumers around the world, so they can understand their consumer behavior and then talk to their consumers in any country across the world. We're very trusted. As I said, this year is our 21st birthday. A company may work with us and they're making multi-million-dollar decisions based on our insights or our campaigns. And therefore, they want to work with an organization that is proven, that they can trust that recommendations and they can trust the conclusions that they derive. And thirdly, we have a great service ethos, and actually our client satisfaction today, our NPS Net Promoter Score is at 82. Anything above 72 is world class, and we're really delivering what our clients want and how our clients want it. What do they buy? 3 key areas, as I mentioned. Firstly, data and insights, enabling organizations to understand consumers better. Secondly, self-service platforms, access to insights and access to campaigns through our proprietary technology platform that we've been developing for many, many years. And then thirdly, excuse me, pure amplify media. And what's unique about our media solution is that all of our media planning is done on that first party data. We have those deeply profiled consumers, so we can help organizations to run better campaigns because we understand consumers better. And then how do we do that? We do that by organizations tapping into our global consumer base that we have. We do that by leveraging that Pureprofile proprietary data that we have and through our technology. So those are the three key areas and reasons that clients work with us today. We have offices in 7 countries. We opened Singapore last September, mainland Europe, beginning of January or end of January. When we open new countries, we just add salespeople because all of our core operations is done out of India, and clients either use our self-service solutions or they use India. So that means any new office we open up becomes profitable within 2 months. So we have offices in 7 countries. We have over 700 clients globally. 155 staff, excuse me, 91% of repeat business from clients, and 20% in reoccurring revenue. So we start at the beginning of each year, we know 20% of our revenue straight away. So truly a global organization. However, we actually delivered insights in financial year 21 across 91 countries. So although we only have offices in 7 countries, we are known across 91 countries today. And much of our strategy is therefore reversing the organization into where we already have strong brand but low market share. People and culture. People are at the heart of everything that we do. If you have the right people, if the team is motivated, rewarded, both in career development, in investment, etc., then that will repeat itself directly into happy clients. And if you've both got high client satisfaction, high team satisfaction, then that results in strong results. So we have a great gender diversity across our business. We have really wide nationality and ethnicity diversity, which is so important, both of those when we're making decisions. Age diversity, for me, very kindly, they cut it off at 40. All of our employees, we rolled out an equity plan at March 21, where everybody received a small parcel of shares. So feel absolutely, and they are part of the journey. And I see many of our staff buying shares as well. And then all of this has resulted in our employee satisfaction is 86% today. That's up 14% on financial year 20. And what does that result in? Higher employee retention, higher profitability. We've got increased motivation and productivity, and improved employee health and well-being. So a couple of metrics I'll pull out. 98% of employees recommend Pureprofile as a great place to work, and 97% of employees are proud to work at Pureprofile. And they're great statistics. It's a fantastic Pureprofile community, and I'm really honored to be part of it. And as it says on the left-hand side, anything above 78% is a first-class, a world-class company. And I would say all of you should look at all of your investments to check what is their client satisfaction and what is their employee satisfaction. And if both of those are high, great organization you should be investing in. I would question if either of those are dipping. Some financial highlights. Full year, financial year 21, we exceeded our EBITDA guidance. We gave EBITDA guidance at the beginning of the year of 2.5 to 3 million. We had EBITDA in the end of the year at 3.1 million. This was up 124% on previous year. Our revenue was at 30 million. That was up 24% on previous year. And really importantly, our full year positive net operating cash flow was 2.4 million. That's up from 1.4 million on previous year. So as I said at the top of this call, we really haven't looked back since the restructure and recapitalization, and strong growth and absolutely standing on our own 2 feet. And as the bottom table shows, this is across all of our business units. So data and insights in Asia Pacific was up 34%, actually the same as data and insights UK, EU, up 34%. And really importantly, our SaaS platform also up at 119%. So I'm delighted, and many months we broke records for revenue and profitability. As we show, I've got this graph or slide to show a couple of financial trends. So from financial year 20, revenue, significant growth. The EBITDA table, I especially want to bring to your attention. This is where I talked about that restructure. So in financial year 19, our EBITDA was minus 1.7 million. Then plus 1.4 in financial year 20, with the restructure being undertook by Melinda Shepherd, COO, fantastic partnership I have with Melinda. And then in financial year 21, really great growth to that 3.1 million. And again, one can see on the right-hand side across a couple of our divisions, we've highlighted that strong trend and that strong growth continues. Also, though, to bring in this slide, our capital expenditure has actually gone down. So our EBITDA is an absolute true number. We're not hiding anything that we're capitalizing behind that. And why has our EBITDA number gone down? Because, our EBITDA number's gone up. Why has our capital expenditure number gone down? That is actually because we are much more focused as an organization. So we're delivering more and actually spending less dollars doing that. And moving forward, we'd expect to see at about $2 million, that capital expenditure number to be consistent. We've also had a phenomenally strong over year to 3.1 million, and again saw that across each of our business units, with data and insights Asia Pacific up 41%, UK up 27%, and our SaaS platform actually up 207% year over year. So fantastic growth, and that is especially bolstered by the new Flybys partnership that we have in Australia. I'll talk about that in a moment, which went live at the end of April this year. We're also delighted to be able to share that our Q1 revenue is absolutely expected to remain in line with our July revenue growth. So we expect Q1 at a minimum to be up 50% year over year. So that was, again, as I talked about it at the beginning of the call, we really haven't looked back, and that fantastic momentum continues in the business. Couple of operating highlights. I'll call out this: 40% of our clients come from new markets outside of Australia, and that is that point about global expansion. As an example, 60% of our revenue comes from Australia today. The UK market, where we're very established, is 10 times larger than the Australian market, and we have a very small market share. So it's quite easy for us to invest and grow into that market and quickly for the UK to overtake Australia as a business. The US market is 40 times bigger than the Australian market. So that gives you an idea of the opportunity around the world. We saw 58% growth in number of SaaS clients, a really important metric, and also 71% year-over-year increase in our completed surveys, and that directly results in more revenue. So I just wanted to pull out a couple of those. Blue chip clients that we work with, as I said, 18% of the ASX 200 uses our insights, or use our insights to deliver better consumer outcomes. And then I've just pulled out a couple of solutions to focus on. Firstly, audience intelligence. We're delighted with this solution. We launched this at the end of April, about 12 months of development. This enables organizations just to log into a SaaS system and identify their own customers. They can look at their whole market and understand how they're doing and how they're doing against their competitors. Think about it for a second. When we go to buy something at JB Hi-Fi, or you go to Woolworths or Coles, or you go to Harvey Norman, etc., you're just a credit card who maybe bought some headphones or broccoli or whatever you purchased. They don't understand your demographics. They don't know where else you shop. Our system helps them understand who their consumers are, who their customers are, and actually how they're doing it against their competitors. Really an important solution. We launched this, as said, in Q4. Uber Eats has signed up as a client, so that's a fantastic marquee client. We've got a number of trials running in the food delivery sector. It's a unique SaaS solution with a couple of patents that we've applied for within that solution. And also we've been shortlisted for the SaaS Innovation Award, which is quite amazing considering we only launched the solution, as I said, in April. And then you will see quite quickly, hopefully next week and soon after that, we will see fast food and retail open as a vertical, gives us access to over 200 plus clients. It's a really exciting solution that will then roll out into other countries. I talked about this. We launched a partnership with Flybuys. It went live at the end of April. This is so Flybuys members can actually earn Flybuys points by doing something other than shopping at Coles or Target or wherever. They can actually deliver insights, etc. We co-branded a SaaS environment with Flybuys as we work with other partners, including News, including Raise, AA, Smart Fuel, SGAG in Singapore. But with Flybuys, again, we created a unique co-branded environment. And since we went live, a new Flybuys member joins every 300 seconds. At the end of last financial year, we awarded in total, there's really half of May and all of June, 27 million Flybuys points earned. And we've delivered over 95,000 surveys across the Pureprofile perks, again, half of May and June. And that big lift that you saw in July of our SaaS platform, big part of that is down to Flybuys, and then you will see other partners and audience intelligence grow out that SaaS line. So really exciting time. Key progress, we focused on 3 areas. Global panel, we doubled the size of the AU and importantly the UK panels. More data, more insights. We launched the Flybuys partnership and a partnership in Singapore. And self-service, we launched audience intelligence and signed Uber Eats. Really excited about that. Key initiatives for this year, you will see more of us talk about new partnerships around the world. Immediately, it gives us the ability to deliver insights for organizations and to grow those markets. You will see new verticals for audience intelligence. I just touched on a couple, and also new panels around the world that we will grow. So in summary, phenomenally strong growth. We're having a great time, really delighted with that, really enjoying ourselves. Cash flow positive as an organization, not having to do any capital raising, etc., to keep the lights on. Highly engaged employees and highly engaged clients, and that's so important to us as a business, and phenomenally exciting solutions. So thank you for listening. And with that, I will hand back to Mark.
Thanks, Martin. Yeah, we've had a plethora of questions come through, so we'll try and get to as many as we can. Just a question on pricing for your SaaS solution. Is it on a per user basis or an enterprise-wide license, or on a per data set used by the customer? Maybe just sketch out the pricing model.
Yeah. we have three solutions in our SaaS family. The first solution is called Insights Builder. Insights Builder enables organizations to build their own surveys, to query people around the world and understand their consumers. That in effect is on a per usage basis. So depending how many people they talk to around the world depends on their pricing. The second solution, which Flybys is a part of, is our community monetization solution. Again, there is a monthly fee on that depending on volume, but more importantly, we actually pay back a revenue share to all of our partners that far outweighs any fee of setup, etc. And that revenue share is based on those members, like I said, 95,000 surveys delivered. All of those Flybys members, we were paid by BMW, Mercedes, Medibank, etc. to do surveys. And that's a revenue share for clients and also an incentive back to those members. And then the third one, audience intelligence. That's the simplest of the three. $5,000 a month for a 12-month contract, and I have access to my vertical.
Okay, great. And just sticking maybe with audience intelligence, the question here seems like more than just customer survey data. How do you source that data is the question.
Yeah, it's actually not customer survey data. So that actually is customer behavioral data. So it's either self-generated. So again, we have opt-in panels around the world who can opt in to share their information. And we also work with partners where those partners provide us with the, in this instance for audience intelligence, in Australia, it's transactional data, so it's anonymous data. We don't know email address, phone numbers, etc., just age, gender, location. And then we, from the data, know that, for example, maybe in your credit card, you went to Uber Eats, or in your bank account, you took your car back to Hyundai for servicing, so we know what car you drive or what insurance is, food delivery, but all anonymous data, and it's behavioral data. Three big types of behavioral data in Australia at the moment. We have transactional data. The other important form of data is location-based data, so that brands can understand how their advertising is related in you going to footfall, when we don't have lockdowns, but footfall into shops, etc. And again, that comes from either our panel who share that information or partners who gather that information by what they do. And the third form of data is media consumption. So that is understanding what websites have you gone to, what TV shows do you watch, and again, from our panels who opt in to share that data with us, or from partners. And brands want to understand what sort of audiences are maybe going to Sydney Morning Herald or Daily Mail or watching Netflix, etc., so that they can tie advertising into that. So three important forms of data. It's all behavioral-based data, not survey-based data.
Great. And then, is the global expansion to drive revenue? What's Pureprofile's competitive advantage it will use to disrupt market incumbents in the US and the UK?
Yeah, firstly, innovation doesn't just have to be new products. It can actually be doing something a lot better than competitors do things. And certainly we deliver for our clients, and our service and our process and our workflow is optimal to our clients. But the three different solutions. So if I look at data and insights as an organization, there are a few global players around the world that we compete with. Two of the main global players, actually we are winning clients hand over fist, and also being able to attract their team members from them. So we clearly are doing something right on that. And again, we already have a presence, as I said, in 7 countries. It's about extending that and growing that rather than just opening up in brand new greenfield sites. When I look at our media solution, what's unique is we do all our planning around that first party data. 90% of advertising is actually what's called programmatic. That's when you go to Google, search for tennis rackets, and then you go to Sydney Morning Herald and you see tennis racket adverts. That's purely programmatic. It's based on just your behavior. Everything we do is actually based on what you believe in, your views, your opinions, etc. So we can be much more accurate to ensure you're receiving the right advertising that you're interested in, the right messages, etc. That's our big advantage there. And our big advantage with our self-service platform is firstly, and I'll just call out too, within our monetization tool, incredibly easy to set up. We have SDKs or mobile ways of setting that up, and a client can be up and running in 2 weeks and connecting their loyalty members to surveys from around the world. So that's really exciting. And then audience intelligence. What's totally unique about that is not only do I understand the what, I can look at my own set, my competitive set, but I can from that interface launch surveys to understand the why, and I can also launch media campaigns. Nobody else in the world does that, hence the patent application. So yes, we have competitors. Innovation is about doing things better.
Okay, great. Martin, we're up on time. Actually, we're going slightly over time, so we'll leave it there. Apologies to anybody if I didn't get your questions, but I'm sure if you email them through to Martin or Melinda or info@pureprofile.com, they'll be happy to get back to you.
Totally will be.
Martin, if you can just stop sharing your screen, because I do know we have Shaun from Energy One waiting in the wings to start his presentation. So Shaun, if you want to start sharing your screen, it's coming through now, and yeah, just go to slideshow. Yeah, there we go. Perfect, Shaun.
Thanks, Mark. Good morning, everybody. Thank you for attending our presentation today on Coffee Microcaps. It's our second appearance here in after our performance last year, so hopefully you'll find the presentation informative. Just a quick a bit background on the company for those who aren't familiar with us. We're a software and services company, predominantly in the energy trading, wholesale energy trading market. We've got a hybrid business model of recurring and project revenue, which is a one-off time and materials type revenue. On the recurring side, it's sort of SaaS software and services. We offer solutions for trading of energy derivatives, including physical energy, which refers to the actual commodity itself, and the derivatives that underpin it, financially settled derivatives and the like, and environmental and carbon trading. We've got offices in Australia, UK, and France. Our headquarters are here, with 230 odd customer installations in 19 countries. We have a good market share in this country. Approximately 50% of the energy in this country passes through our software on its travels, but a much smaller share in Europe, and that's our runway for growth. And importantly, we've had a strong track record of year-on-year growth in earnings and revenue, which I'll come to in a minute. As I mentioned, our customers are all varieties. Blue chip customers, they're household names. We also have pure play type energy companies, like a solar farm or a wind farm or a battery or a retailer, and on the customer side as well, energy consumers, large energy consumers, but also the financial traders as well. There's a lot of financial trading in the derivatives, people not taking a physical position, just trading. And so there's a variety of companies from pure play right through to household names. So a quick look at the financial results. It was a great year. We're all very happy with this result. It comes on the back of many years of growth, so it's great to be able to continue to deliver. Revenue up 35%, obviously, and obviously a good performance on the profit side of things. Pleasingly, we were able to pay down all of our debt. The facility still exists, but we now have zero borrowings going into this financial year. And the business is obviously cash flow positive, strongly so, we're in good shape. So just drill down a little bit more on that. This is our 8th consecutive year of profit now. And, as I said, revenue's up 35%. This is obviously driven in good part by having 12 months, full 12 months from our EV Energy French compatriot company. But leaving aside that contribution, organic revenue for the business was 15%. So about half the revenue is organic and half it was inorganic in growth in the last year. The same is true for the EBITDA line. So if we strip out the contribution from EV, underlying EBITDA growth was 26%. And we were helped along a little bit by reduced costs from travel and marketing, but nonetheless, it was still a great result. Strong operating results, obviously getting synergies and operational leverage across the business. We managed to grow our EBITDA margin from 26% to 29%, which goes to the core of our strategy, which is to even by inorganic growth to generate organic growth and margin increase as well. And we're helped a little bit by lower acquisition costs in this period. So this sort of goes to our strategy, which has been a long-standing strategy now over a number of years. The primary element to it is diversification, which is both a risk management exercise as well as a growth exercise. So diversify our product base, more products available to customers, including services as well as software. Combine products to create new solution sets for customers. Typically, that might be a physical energy trading product attached to a derivatives trading product, so the customer can trade on both sides of the market. We also cross-sell across our geographies as well, Australian products going into the UK, and also in Europe, the UK and the French business got together and won a major customer there. The second part of this is organic growth. Obviously, geographic expansion. We've, in the last 2 years, have moved into Europe, which is a big runway for growth for us. We'll talk about that a bit more. But you know, the European business now represents 50% of our revenue, whereas 2 years ago it was, 3 years ago it was zero, and all of that revenue is profitable. And lastly, the inorganic part of the story, which is key to landing and expanding in these markets, because customers are very sticky, as we know. So it's great if you can find a complementary business that gives you the starting point for which to service customers and to grow your brand and your credibility as well, because this market relies on credibility and track record. So our strategies work. We like to think several years of growth, revenue growth 45% per year, and EBITDA 48% over the last 5 years. We'll drill down on where that revenue comes from. You can see the story here in this slide. The grey line is the Australian underlying market. So we're talking about a market which we've got a nearly 50% market share, and we're continuing to grow that business. But look at the slope on the curves for our European story. This is where obviously a bigger runway and greater opportunity going forward. That's the nub of what we're doing. Obviously, NPAT was strong for the year. The interesting thing about the slide, leaving aside the increase in NPAT, is the first half, second half split. I think I find this quite informative to show that the business isn't really symmetrical from half to half. So we have, you might have a strong first half and a more modest second half and vice versa, apart from FY21, as you can see, is virtually 50-50. But that's driven by the fact that we have projects, implementations, customizations, a few large projects per year that sort of wax and wane on their timing. So customers don't always sign exactly on the 1st of June and the 1st of December. So the flow of the projects sort of ebbs and flows a little bit during the year, a bit like buses. You don't come along and then you get 2 or 3 at once. So that's sort of timing issues related to the project revenue, which is, as I said, 20% of our income. But all of this amounts to a steady increase in returns to shareholders. We've announced a 6 cents dividend for the financial year, and we have a dividend reinvestment plan underway as well that's underwritten. So, as I mentioned at the beginning, strong cash flows from our business. Total receipts from customers are up 31%. And operating cash flow has obviously increased 62% as well. So we've got, as I said, this comes from a strong recurring revenue base. It's greater than 80% across the group. The other 20% is project revenue, but it could be, we could technically have a higher recurring revenue, but it does, the percentage relates to whether or not we had more or less project revenue during the year. And the business is in great shape. The balance sheet's very strong and it's cash flow positives. Let's have a look at the operational review now. The Australian business, as I said, continues to grow. Revenue up 13% in a market where we have a strong share. EBITDA margin again increased in the Australian business. The big news during the year was the 5-minute settlement market change that's coming through on the 1st of October. So everyone in the market now has to settle their contracts over 5-minute time buckets rather than 30-minute time buckets, which doesn't sound like much, but it's an enormous change to the fabric of the way the market operates. And we spent the last year or two getting our software ready for that. So we're ready to go. Everything's been tested. All our customers are equipped now for the market change at the beginning of next month. And we're also expecting to pick up some stragglers or new customers who perhaps get into the new market and realize they need some additional software to help them. Obviously, each year in the Australian business, we need to win 1 or 2 projects, which we've managed to do over a long period of time. We need those signatures going into the year, but as I've said before, we've done this year on year, so we're confident that we can get those. European opportunity, yes, exceeding our expectations, given that 3 years ago we didn't have any European revenue. It's 54% of the group revenue now. Contigo in the UK delivered 17%. Europe was heavily locked down, had curfews and everything, much like we're experiencing in this country now. So they had a long period of being locked away, but they've managed to get 17% organic revenue and increase the margin as well. So terrific result from Contigo. And the management team there have grown the EBITDA margin as well by doing all the small things in a good way, pricing control, that kind of stuff. Easy is our newest member of our family, done that terrifically well. They've been with us now since June of last year. Exceeded all our expectations for that business, and they've got together with the UK and already won a major European utility contract together. Like Australia, Contigo needs to win 1 or 2 projects a year to get that non-recurring revenue stream. Easy's model is much less dependent on projects. It's more pure SaaS and services. Going into the year, we've had a minor operational restructure just to sort of facilitate the future growth. We've appointed an Australasian CEO, Dan Ayres, who's been with the company for a number of years and has been instrumental in the Australian business growth. Now that we've got a dedicated CEO for each of our businesses, and my role is more of a group role now, so less operational, but we've got some strong talent there. We're also going to invest in Europe as well going into the year ahead, where some more sales resource and managerial resource to help us position us for that market when it emerges, as it will do from the COVID slumber. So just some SaaS metrics here, just to sort of give some context to some of the operational stuff. Obviously, churn is relatively low in this business. It's very sticky. Customers don't usually move on. They don't churn away in a traditional sense. We would lose customers because perhaps they market exits or mergers where 2 license fees might go into 1, that kind of thing. But gross margins here, I want to draw your attention to that. This is a hybrid gross margin. Obviously, those familiar with SaaS businesses would be expecting to see a higher GM, but this is made up of our T&M margins as well, which are obviously high quality people that we're utilizing. So this is a hybrid margin that considers all of the aspects of GM, as opposed to a simplified revenue less hosting costs that you might think of normally. So this is the margin that we use to drive the business, and we've steadily built that up over a period of years. The last point there, we seek to sell more than one product to our range of customers. Our current average is 1.3, and the most penetration is 5 products. A lot of customers, there's a long tail of customers will only ever use one product, so the smaller end of our customer range, but there's a lot of customers using two or three products. So just quick slide on the rule of 40 here. You can see, although it fluctuates, I think it emphasizes the health of the business. You know, past that rule in each of the last 5 years, but it is interesting to see how, you know, the business does move around, but it continually passes that test. We've long focused on recurring revenues. That's very important to underpin the business. We're looking at 80% in each year going into the year ahead. The bit that we need to work on, obviously, is the orange bit, which is just winning projects. And that's the bit that's sort of the challenge each year we go into, is to get those signatures. But as I said, we're not talking about a lot. We need to get 1 or 2 projects per year in each of the businesses. But the main focus is building that tail of recurring revenue that occurs after we've won an installation and installed it. And of course, the customer continues to pay license fees and support going forward. Outlook, the market's changing, as we all noticed, anyone who turns on the news. Green power, decentralized power resources, distributed energy, virtual power plants, these are all the buzzwords of the new market, but essentially it is disaggregating, and there are more smaller players coming into the market than the traditional household names. So, and the mix is changing as well. Long ago, one thermal coal station, not anymore. The mix is very eclectic now, and as the market goes forward, we'll be seeing more customers who need, you know, there's smaller customers that's in that segment who need a different style of solution, which is often characterized by having services as well. So a traditional large player would have had a 24/7 trading desk in-house and that kind of thing, whereas the smaller new entrants would look to outsource some of that, either to buy software that does it for them or services as well. So with Easy Energy, we have a business already established in France that does exactly that, 24/7 deal execution. So we're not trading on behalf of the customers, we're nominating into the market, given a set of rules. So we don't take market risk for them. This is deal execution, you know, in an equity sense, but we're basically nominating 24/7 so that that customer can fulfill their obligations to market. So we're gonna push on with that services model. It's a useful corollary to our software story, and we're also looking to introduce that into the Australian market in the next couple of periods as well. Our automation software, Enflow, helps us for that. It helps us leverage that because a lot of the tasks are manual, and so if you can automate some of them, it gives you the operational leverage to be able to deal with more customers or function on behalf of more customers. The slide just addresses the story of diversification over a number of years. I've pointed that out, that diversification is key to our strategy. And so we've gone from, in 2013, having 90% of our revenue invested in one product through to having that product. That's still a major product, but less than 17% of our revenue comes from one product now. So that helped to underpin the long-term security of the business. So we'll continue with that strategy going into FY22, looking for additional acquisitions where they come up if they're appropriate, but also organic growth, and continue to expand our diversification story into services as well, as I mentioned. So our focus is going to be consolidating where we are, getting back into the market now that COVID is hopefully on the way out. We're going to invest additional resources. We've got a good pipeline of work. We just need to get some signatures going into the year, and we're expecting things to pick up, certainly as travel restrictions ease. So our guidance to the market has been that we expect it to be similar to last year, assuming these things happen and we don't execute you know, additional project sales, or there's no acquisitions. But obviously we've done it over a number of years now, so we felt it was better to be clear about how things are looking, and of course we expect that we will come through and produce those results. But we're also got a strong balance sheet, good cash flow from the business, and we continue to look at our strategic progress in the market here and abroad. Thank you very much. Any questions?
Thanks, Shaun. If you wouldn't mind just, maybe leaving up that final slide so people can note down the inquiries email address if we just in case we don't get to all of these questions. If you can leave that one up, that'd be great. First one, which geography does he think the next acquisition will be in? So I'm not sure if that's, doing something to get you into a specific European market, or I know you have looked at potentially entering the US market at some point in the future. So maybe just comment on that.
Yeah, that's right. So there's, as we mentioned in a previous slide a couple of years or so ago, there's not, like the customers, there's not an infinite number of acquisition opportunities. It's finite. The pool is finite. It's a niche market. So where there's not millions of players to look at, so you have to look carefully at who you deal with and who we partner with, and so that takes time and effort. And so it's very important for us to find someone that works at the right time, works for both companies. And so we're always looking, is the short answer to that. And we're always in the market. We're always talking to people, and which shoe drops first, of course, is a matter of timing and opportunity. But we are focused on the European market. We did suggest that we would move into the US market as the appropriate opportunity arises. But we stick to our knitting generally at NG1, so we want to make sure we consolidate in Europe and in Australia, as well as looking at opportunistically at whether or not the US can be on the horizon in the short term. But we are definitely moving towards looking at that as in the medium term.
Okay, great. And another question, what's the rationale behind reintroducing the underwritten DRP? I know when you started the underwritten DRP program, it was primarily to, try and improve liquidity in the share, but what's the thinking behind it these days?
Well, that's still true. The DRP has been quite useful as sort of putting liquidity into the shares. A few years ago, management and directors owned 75%, down to like 52% now. So it's an active campaign over a number of years to get that in a way that's meaningful. The underwritten allows us to preserve cash, but just also to reward the shareholders for sticking with us over a long period of time.
Okay, great. And then a question, how do you think about capitalizing wages and amortization of the development work that happens?
Yeah, sure. So we obviously have a very strict policy on capitalization. It applies only to where we're creating new assets. It's not a generic capitalization process. So we also benchmark it in the low teens. The company has traditionally done about low teens, let's say 12 or 13% of revenue is capitalized, ends up as capitalization KPI. So we do it in order to better reflect the life cycle of the software. I mean, you put a lot of effort into developing new software, and it's got a useful life of at least 10 years. So it's about just reflecting the costs and the returns on that. But we also make sure that as I said, it's conservative. It only applies to new assets. We do a lot more innovation than that. There's a lot more investment goes in, but that proxy, the capitalization line, is a proxy for the investment we're putting into R&D.
Next one, what percentage of customers are A, household names, B, pure plays, and C, traders? And what type of customers the company looking to acquire focus on in the European business?
We, as an active strategy, have looked at diversification over a number of years. moved away from making sure that it was all, one, two large customers. Our three largest customers now, I think, are something like 25% of turnover. We actively looked at having different products for different market segments. And that's what we've done. We have a long tail of smaller customers. As I said, we might use one product. A good example of that is our NemSite product, which is a market analytics, so a kind of a Bloomberg terminal product that you can just sign up for and get market reports straight away. That's a sort of a light touch access to the market. So we have a lot of customers that we measure customer installations, because some customers have more than one product. So we're up to 230 now. But as we published a few years ago, there's in this country at least, there's probably less than 20 large players out of 200 or so. So obviously you have to make sure that you've got something for everybody. But in Europe, it's the same story, but obviously just a bigger canvas. The market there is 10 times the size. Easy's business is reflective of dealing with smaller customers who are looking to outsource. And Contigo's business, as I mentioned, because of the project comment, they're obviously trying to pick up larger customers as well, the sorts of customers who would require a larger installation process. So we pursue all of our customers across all the segments. And one of our differentiators is the fact that we have products and services for each market segment. So we don't discriminate. We do try and sell to as many products and services to as many customers as we can.
And then a question more around the revenue model. Maybe if you could just detail into it a bit. The question is, was the revenue model, is it per trade, per user, or enterprise? Maybe within that, I'm guessing it's more enterprise based, but maybe I think the question is there a transactional component to it as well for the guys who are doing the trading?
Only to the extent to which it reflects on the complexity and the size of their business. It's not, we don't get paid per transaction. So smaller customers will use, it's traditional in the sense that use seats. So number of seats for users, or also the modules that they're using. For instance, if you're trading electricity and then you wish to trade gas as well, that's a new module. But so the size of the customer business, the size and complexity of their requirements flow through to the pricing as opposed to transactional.
Okay, great. Let me just double check here, Shaun, if we've got any further ones. I don't think so. I think we've covered them all. Yeah. Shaun, we're pretty much up on time. And if there's no further questions, let's leave it there. Thank you very much for, as you say, coming back and joining us again and giving us an update on all things Energy One. And we'll look forward to seeing how the story pans out over the rest of this year.
Thank you, Mark, and thank you everyone for attending. Appreciate it. Thank you.
Okay, thanks, Shaun. Thanks, everyone, and enjoy the rest of your Thursday.